Assalamu alaikum. Today I'm going to talk about growth stocks and how to value them. It may be tempting to look at the PE ratio for a certain ticker symbol or some other valuation metric and make investment decisions based on those valuation ratios alone. However, I would argue that taken out of context, there's very little value one can get from just looking at these valuation ratios. After verifying that you're comfortable investing in a certain company from a halal standpoint, the starting point for a great investment is being a fan of the company's product and what it's trying to do. After this, there are 4 primary factors that I like to look at when I'm valuing a growth stock. The first thing I look at is whether or not the company has a moat, a durable competitive advantage. The second thing I look at is the market cap of the company that I'm considering versus the size of the overall opportunity. The third thing I look at is management's track record in innovation and adapting to new market conditions. And then the fourth thing is the company's growth record. How fast is the company actually growing? As you may have noticed, looking at just the financials of a company is going to help you precious little in identifying any of the factors that I mentioned, with exception to the last one, which is basically the growth rate of the company. In fact, from a valuation standpoint, many of the best investments in history have gone through an extended period of time wherein they looked massively overvalued if you were going to look at their valuation using a traditional lens. Take Amazon, for example. On September 30th of 2015, Amazon had a PE ratio of 720 when it was trading at around $511 per share. Now, many looked at this PE ratio and said this was outrageously high and stayed away. After all, the average historical PE ratio for the S&P 500 is only 20. However, if you had invested in Amazon on September 30th, 2015 and held until today, when it's trading for more than $3,000 per share, you would have made a near 40% average annualized return. Today, many people think that Tesla is massively overvalued. So let's look at the 4 factors I mentioned to see if they're present in Tesla. In terms of a moat or competitive advantage, Tesla has multiple moats that relate to its technology. So let's take the example of autonomous driving. Unlike most automakers and tech companies that are working on autonomous driving, Tesla doesn't only rely on an internal testing fleet or simulation data. Tesla is leveraging its large customer fleet of electric vehicles equipped with an extensive array of sensors to collect real-world data and improve its driver assist features. It currently has at least 4 billion miles of real-world autopilot driving data, which is being used to improve its autonomous driving algorithms. The next closest competitor, Waymo, if we're being generous, maybe has 30 million miles of autonomous driving data. So you're talking 2 orders of magnitude less than what Tesla has. And to add to its moat, this difference between what Tesla has in terms of autonomous driving miles and the next biggest competitor is increasing with time. And I just don't see any other competitor being able to close that gap with Tesla anytime soon. It seems like Tesla's lead at this point is basically insurmountable. So it's clear to me that Tesla has a very durable moat. It has a competitive advantage that can be relied upon at least for the next few years. The second thing is the market cap of the company I'm considering versus the size of the opportunity. Tesla is currently trading at a $600 billion valuation, or roughly $600 per share. Now, if we look at the entire global market for autonomous vehicle services, some estimates put it at around $8 trillion. Now, that valuation includes ride-hailing at $5 trillion, $2 trillion for freight, and $500 billion each for data insights and in-vehicle experiences. And this is just autonomy. I haven't said anything about car sales and insurance and power generation and storage. And the power generation and storage, that business may be just as big as Tesla's auto business. The third consideration that I like to look at when I'm valuing growth companies is innovation and adaptability. This is important because the business landscape is constantly changing, and you need a management in place that is adaptive and can innovate to fend off threats as they appear. As it relates to Tesla, I can't think of a company that's more innovative. For example, Tesla recently introduced a revolutionary new battery cell. The new cells aren't the only potential game changer for Tesla. New underbody castings, battery packs, manufacturing process innovations, and the list goes on and on. The fourth factor I mentioned when I'm valuing growth stocks is the growth that the company has achieved thus far. And in terms of Tesla, it looks to me a lot like Amazon 5 years ago. So Amazon, if you look at the growth rate year over year, September 30th of 2015, so going back to that comparison point that I referenced earlier, the year-over-year growth rate was around 25%, whereas Tesla, in its most recent quarter, the year-over-year growth rate was close to 40%. So I think there are a lot of similarities between the Tesla today and the Amazon of 5 years ago, and there's probably more upside for Tesla than there was for Amazon. So Tesla checks off all the boxes for me for a growth stock. It has a moat, has a relatively small market cap compared to the size of the opportunity. Its management has a track record of innovation and adaptability, and it has a solid growth record. For people who are really fixated on whether Tesla should be worth $600 a share or $500 a share or $700 a share, I think they're missing the bigger picture. When it comes to high growth stocks, it's not as much about the price that you pay today as it is about the long-term value that you're buying. If you understand the factors that I mentioned, you'll be able to identify the stocks that are posers as well. These are stocks that have very high valuations, but these valuations are more attributable to hype than they are to actual substance. So let me give you a few examples. There's a lot of hype around electric vehicles right now. So people figured out that there's going to be a lot of demand for electric power charging stations. So a lot of investing is going into companies that are in that space because they figure the market for their products is growing very rapidly. And to that, I would say caution is probably a good idea because power charging stations, I view them basically as a commodity. There's no innovative technology there. I mean, basically they're producing electricity. You need to answer the question, how is this company that I'm investing in, that I'm buying at a very high valuation, how is this company going to maintain a competitive advantage? Does it have a moat around its business, or can basically anyone do what it's doing or what it plans on doing? Another example would be the plant-based protein industry. This is an industry and a market that's growing very rapidly. There are a lot of players in this space. Maybe one of those players has a competitive advantage in terms of the taste of their product. The question is, what if another company comes out with a better tasting product? A product that is closer to the real taste of meat than my company. Does my company's management have enough of a track record in terms of innovation and adaptability that's going to allow them to compete with this new product? Have they proven that in the past? Now, it may be the case that you have a company that doesn't have one of the 4 factors that I mentioned. So it doesn't necessarily have a moat, or it doesn't necessarily have all-star management, or it doesn't necessarily have a track record of high growth. And yet it ends up being a fantastic investment. And it ends up being that because of management's impeccable execution and their speed to market. This is entirely possible. However, it's far more difficult to identify when a company's management is going to have that kind of performance ahead of time than it is to identify companies that have the 4 factors that I like to see in growth companies that I invest in. And generally speaking, I'm looking for the no-brainers. I'm looking for the home runs, the things that are obviously going to work out as much as possible. And I try and shy away from investments that maybe are 50-50. Because over time, I think that policy of sticking with the obvious plays will yield and has yielded really good results for me. Now, everything I said in this video is my opinion. Make sure you do your own due diligence before you make any investment decision. If you want to buy stocks in the United States and you'd like to try out M1 Finance, the brokerage that I use, try it out using the link in the description below to support the channel. I hope you found this video beneficial. If you haven't left a like, make sure to do so. Until next time, take care of yourself. Assalamu alaikum and peace be upon you all.